Good evening. There's mayhem going on in the debt market, and I know most of us are blissfully unaware of what's happening, but the magnitude of the problem is quite big if the mutual fund industry finally implements the SEBI circular, which was issued on Wednesday. So I thought I'll give you a quick brief on what's going on and how are we supposed to react if the circular is implemented. But before we get onto that, I need for you to know what are AT1 bonds. The circular has been issued for AT1 bonds. So AT1 bonds are perpetual bonds. Now, what is a perpetual bond? So let's say I'm Punjab National Bank and I issue a bond, and that bond does not have a maturity date. It's called a perpetual bond, right? Perpetual bonds almost always carry a call date. What is a call date? So I, as Punjab National Bank, can issue you a bond which is perpetual, but let's say after 5 years or 10 years, I have the option of calling back that bond. So that's called a call date. Now, how are perpetual bonds valued in the market? Almost always, perpetual bonds are valued on a yield to call basis. So I know that's a bit of a jargon. So let me decode that for you. What that means is, so let's say Punjab National Bank issued a bond, a perpetual bond with the call date of 2024, right? So now when I am buying and selling bonds in the market, my price is determined on the fact that this bond is likely to give me back my money in 2024. In theory, while perpetual bonds exist forever, almost always in practice, these bonds are bought back on the call date. So that's how the pricing works. Now, SEBI in all its wisdom, and I don't know what that wisdom was about, came out on Wednesday and said that A, value the perpetual bonds as if they have a 100-year maturity, and B, there are certain restrictions on the limit of perpetual bonds that you can keep per scheme. It was currently at 20% and they wanted to bring it down to 10%. So let's tackle point number B first, which is an easier option to tackle. So in point number B, what they've said is that you bring down the holding from 20% to 10%, but they've given you a grandfathering clause. So without getting into the technicalities of it, what that means is that I, as a mutual fund scheme, if I'm holding a perpetual or a combination of perpetual bonds of, let's say, 17%, and I need to bring it down to 10%, I do not have to rush to sell it. I can take my time over time and sell it as and when I get the right price. Now, where is the problem in this circular? The problem is in point number A. So where they've changed the valuation, the methodology of valuation of the perpetual bond, which has caused a lot of mayhem on Friday. It was chaos. So when you're now, let me try and put it down in layman terms how this is going to cause a problem. I, Hena, am Punjab National Bank. Okay, I issued a bond to X at 100 rupees. You bought that bond from X at 99 rupees. The call date was 2024. So you said that I made a profit in, 21 to 24 in 3 years, right? Now, if I come and tell you, don't value that 1 rupee as if you made it in 3 years, but value it as if you made it in 100 years. Immediately your price falls, right? Because it becomes so much less attractive to you. So that's where the whole chaos will come in, okay? I've explained it in very, very layman terms, but that's the gist of the problem is that there is no real problem with the bank, but because you're changing the methodology of valuation, that the price of those bonds are falling. Now, if the price of those bonds fall, your NAV falls, right? Now, the good news is that Ministry of Finance has actually come out and said, asked SEBI to relook at it or hold it. There have been representations by AMFI as well and the mutual fund industry as well. As of Friday, they had not implemented it. Hoping and crossing my fingers that we have further explanation by the time we come into Monday. What does that mean for you? What it means for you is, if this circular is implemented, your debt funds, your hybrid funds can take major hits depending on how much percentage of AT1 bonds they're holding, what's the maturity of those, maturity call of those AT1 bonds. What does that mean for HNIs? What does that mean for people who are willing to take a little bit of risk? If there's panic selling in the market, go and buy it. I like AT1 bonds. I like good quality PSU AT1 bonds. So if you are sure about those, you're sure about the quality of what you're picking up, it might not be a bad time for you to buy it. Now, what if you're already holding AT1 bonds as an individual? So this fluctuation that's going to come in price is something that's going to happen in the market. But if you're holding it till the call date, right, you will get back your principal, assuming there's no default. So the volatility in the price is temporary for you. So there's no real reason for you to panic. It's just that mutual funds, because they are marked to market and their valuation is determined basis the price of what is traded in the market, they take a hit. Okay, so even if you're in mutual funds, then that's another point for you, right? So when these bonds start maturing, let's say the 20241 matures, and Punjab National Bank actually gives back the money, let's say to a mutual fund, if a mutual fund was also holding. So you'll also get a jack up in your NAV at that point in time. So the moot point being here, don't panic. Stick with the fund. It's not like you'll have a choice, because if the circular is implemented and by the time you react, the NAV would have already fallen. But I don't think it's going to be implemented in the current form. So with that, good evening, good night actually. Have a nice weekend.